Ladies and gentlemen, crypto lovers from across the world, welcome to your favorite community call here in the Convention Center at 88 MPH. We got a big one for you today, folks. For those of you who don't know me, my name is Whipper, and I'm a crypto enthusiast and a community volunteer at 88 MPH, and I have the pleasure of hosting these calls on a weekly basis. Today, we are joined by a very special guest, and it's our pleasure to host Alex from JellyFi. Before we dig deep into the call, I'd like to remind everyone here on stage to please keep your mics muted unless you're speaking. Our open to the public Q&A section will run at the end of the call, so if you have any questions, please feel free to raise your hand so we can bring you up on stage. As with tradition here at 88 MPH, we will be closing the call with a $100 raffle giveaway in the form of one MPH, as well as minting POAPs for those who joined us for this call. On the agenda today, we will be discussing under-collateralized loans, capital inefficiency within the current DeFi ecosystem, news and updates from both 88 MPH and JellyFi, followed by our raffle and the minting of our POAPs. With that, I'd like to open up the call with Alex from JellyFi. Can you please give us a brief introduction into who you are, how you got into this space, and what is JellyFi?
Hi everyone, thanks Peter for the intro.
Alex, I think you're having audio issues again.
Really? Like, super weird.
It's almost as if you were muffled. Earlier you said test, test, and we heard you, and then it immediately went quiet again. So I don't know if you can change the setting to go back to that.
Yeah, I mean, the funny thing is that everything is in default, and I just reset. I did reset everything to the current settings.
Hey guys, we seem to be experiencing some technical difficulties. I think we're having an issue with Alex's audio. I'm not sure what you did last time, Alex, to fix it. You want to try it and attempt that again?
I will try to hop on my phone.
Okay, we'll give Alex a couple of minutes here to try to get his audio sorted out. In the meantime, those of us that are joining us from JellyFi, I just want to give you a quick intro into 88 MPH. 88 MPH is a protocol that's focused around fixed interest rate lending. Your crypto is put to work while generating guaranteed interest based on the timelines you choose. It looks like Alex is trying to make his way back in here. And here we go.
I think it's better now.
Yeah, that's
much better.
Okay, cool. Very sorry for that. Yeah, seems like my Mac doesn't appreciate Discord. So yeah, thanks for having me today. And yeah, to give you a brief introduction about me and JellyFi. So I got into crypto into 2017. Just went with Ethereum, just heard about it and fell in love with that. Shortly after, in 2018, I joined Consensus, and I've been working there for 3.5 years before quitting and building JellyFi, basically. So I'm an engineer, and I worked previously as a blockchain core engineer. And yeah, I've been building JellyFi for the past 8 months now, with my team, which also happened to be from Consensus before. And so yeah, JellyFi in a nutshell is a new capital efficient lending protocol, and we aim at tackling the corporate credit market using zero collateralized loans. So yeah, that's it in a nutshell.
Perfect. Thank you for that introduction. So this brings us to the first segment of our call, which is going to focus on under-collateralized loans. So in my the DeFi ecosystem is under-collateralized. It looks like JellyFi is trying to solve this issue. So I have to ask, how is this being done? Like, are you guys using some sort of a credit system? Maybe you can give our audience just an idea of how this problem, which no one else seems to be able to solve, how did you guys figure this out? What are you working on? What's your strategy?
Yeah, so it's complicated indeed, because there is a lot of pieces. we do not intend on tackling that alone. And I think the main reason as why it has not been done before is because the Ethereum and DeFi was not ready for that. In order to do so, you need to have like other layers of infrastructure that needs to be built first. And I think now it's done. You have those layers which have been built and that you can rely upon. So I think it's time for, and we are not the only one building and tackling this problem. So you can see that in the market is starting to shift, and that there is a lot of other solutions which are working on this. There is multiple aspects that you can tackle. You spoke about credit scoring, and that's one of the main elements that is part of the big like collateralized and under-collateralized question. There is a lot of services which are being built around this. We have been talking with a number of solutions which are trying to build what they call DeFi passport or credit scoring stamps, NFTs and stuff. So we are looking to do that ourselves internally, but we don't think that we should rely solely on the product that we are building in terms of credit scoring, and we also want to take advantage of what the ecosystem is building, and so building partnership with those people make a lot of sense. So yeah, that's the credit scoring part. But obviously, also you need to build the whole infrastructure. So as of today, there is only ways for people to borrow for peers, basically. Most of the lending and the borrowing is done by peers and corporate, but on the lending side mostly. So we saw that there is a lot of actors which are on chain that needs liquidity, and which, as of today, if it makes no sense for them to go and borrow on Aave or Compound, I don't know, $1 million in the USDC, for instance, if they have to put 1.5 million as collateral. It's not capital efficient at all, and most of the on-chain actors can't do that. So we are here to provide a solution for them and to provide an alternative, basically, because it's not like they can also go to a bank, a traditional one, and have a loan there, because I'm sure you know banks don't like crypto. So yeah, that's about it.
Right, for sure. I'm so excited about learning about all this stuff because I love when new solutions come out, especially ones that will make the DeFi ecosystem more capital efficient. You mentioned these on-chain actors. Could you give us some insight into like who is an on-chain actor and like how does one even qualify, so to speak, for like a uncollateralized loan?
Yeah, sure. When I say that, I refer to those startups that have been building on Ethereum for quite some time, or even actually which can also be quite young, and raised some money, are building a product, and focus solely on blockchain. So their businesses are on the blockchain. Their P&L comes from the blockchain, and they found their product market fit on the blockchain. So those are what I call pure blockchain actors, because those are companies that are employing people. They have a reputation. They are earning money on the blockchain, but they can't. Weirdly, they can't go to a bank and say, okay, I needed to actually have some funds, more funds, in order to develop our product, our protocol, hire some more people and stuff. They can't do so because the bank prevent them from doing that. So actually, the only solution for those actors as of today is to raise money from funds or private investors, basically. So it's not always a good thing to raise funds from VCs because, well, it is most of the time good, but at some there is some moments at which you would prefer to raise later because you know you will be in a much better shape in 3 to 6 months. You will have a product which is live on mainnet, or you will have another feature which will be live and add much more TVL to your protocol. You will have, I don't know, you will have much more time to develop your product, and you will have better things to sell to your investors, and so you could have like a much better round in 3 months. But if you happen to be short on runway, that could be harmful to you, and you could do a raise, which could be not that great for you. So I think it's like having a bridge between Series A to Series B's, or between seed to Series A is a good use case. But you could also have other protocols which are super fine in terms of development and cash flow, but they need more liquidity because their businesses require them to have a lot of liquidity on a variety of assets. And those protocols, they might be willing to hold a number of USDC, USDT, or DIVE, whatever stablecoin, is as well. But yeah, holding even blue chips assets such as Aave Comp or Sushi, Aave Comp Sushi tokens, they are kind of reluctant to hold a big number of those assets because it's quite volatile, right? So if you can borrow zero under collateralized or zero collateralized those assets, they would be super keen to actually doing so to do so. So those actors such as DEXs, could be market maker, it could be even hedge funds, it could be like I said, young DeFi protocol or much more established one. Actually, there is a lot of people which are interested by this. And in the beginning, when we started this protocol and the journey with JellyFi, I had like a hard time figure out who could be your prime customers. And at some point, I was kind of afraid that we could not find a product market fit. But when we actually started to talk with the right people, we actually understood that the market was super vast. There was like a lot more people that I thought that would be interested in the product.
Right. Super interesting. So to give us a sense, I guess because most of us are, typically used to over collateralized loans, can you walk us through like a typical loan from start to finish? Like what's the process of like loan repayment? What's the borrowing cost? Maybe you could talk a little bit about that.
Yeah, sure. So yeah, full disclaimer, it's not live on mainnet yet, so everything I'm about to say is bound to changes, and we are actually working on our V1, which we aim at releasing later this year. And everything which I'm about to say is bound to change. So the typical process is go through the community. So have a proposal saying that you want to borrow, I don't know, like 1 million let's say 1 million DAI, and you propose that to the JellyFi community. The proposal is reviewed, and we stamp that with a credit scoring note. And the community will be able to judge whether they want this protocol to access a credit line from JellyFi or not. If the process is validated, this protocol can have access to a credit line from the product from JellyFi, and we create a borrowing pool which is attributed to this protocol. People can peers can delegate their credit lines delegate deposit funds to this pool. They will also be at some point be able to delegate their funds from other protocol. So if you are, for instance, lending on Aave, you will be able to use the credit delegation feature from Aave to delegate your assets onto JellyFi, and so you will be earning basically the Aave rewards and the JellyFi rewards at the same time. And so this go on. So for instance, if the protocol is ABC Corp, they want to borrow for a week, 1 million USDC. So like I said, we are building the borrowing pool, and as soon as this pool is full, then you can add some extra liquidity, but the APY is going a bit lower and lower. And so the idea then is for this protocol to repay at some point, right? So there is a number of mechanisms that are put in place in order to mitigate the risk of counterparty, and so the risk of this protocol to go default. And if the protocol repays at the end, then there is an interest rate which is paid by the protocol, which is going back to the users, to the lenders, and that's pretty much it. On the whitelisting part, obviously we will be asking a number of documents from the protocol. So it's not like everybody will be able to come to JellyFi and make a proposal. You will need to have a certain grade, and so that we can make sure that you are actually a good actor, and that there is not much risk involved in lending money to you first.
When you say documents, can we assume that these actors, on-chain actors, would have to provide KYC information or be made public? How do you go about that?
Yeah. In a nutshell, that would be that. Not sure yet as to. I mean, you could have like KYC. You could have like very, very tight process, like which demands a lot of documents, and you could have smaller KYCs with just a handful of documents, which proves that you have an entity and stuff. So it's not very. We're not very settled on where to put the cursor as of today, but we plan on asking documents to those on-chain actors. But it's not that you are on a chain actor that you don't have those documents anyway.
Right. And what would you? Obviously, I know it's not live and everything is subject to change, but like, what could we assume the borrowing costs would be on JellyFi?
Yeah. So the borrowing cost of the protocol is. So it could go from. So obviously, it will depend on the asset which is borrowed, and it could go from 15% to 4%. So yeah, that's a big range. But it depends on the use case, on the entity which is borrowing, and also from the asset which is borrowed. So yeah, there is a number of variables which can impact this interest rate.
And what would happen, like in the case of a default?
So in case of default, you would have there's a number of mechanisms which are put in place. I'm pretty sure you all have been familiar with Aave. In Aave, there is a safety module on which the community is taking, and if there is a very bad event which is happening, the safety module is triggered and it's used in order to recover the losses of the community, the people involved. So we are doing so as well. There is a safety module on which you can stake, and which will be used in order to cover the losses of the LPs. We also want to mention that at an architecture, on a architectural level, we are making sure that the risk is mitigated as much as possible. So, for instance, on the other under collateralized protocols, when you are a company, a protocol, and you are borrowing from them, you are borrowing from a central pool, and if you actually go default, you impact the whole community. So I could be part of this protocol community, and I could vote against a protocol joining, and I don't know, for some reasons, at the end of the vote, there is 55% of the people agreeing on this protocol to take a credit line, and 45% saying no. This protocol end up going default, and I am impacted, and I did vote no. And so for us, it's a real issue. So we actually segregated every pools into sub-pools. So there is one big pool, but whenever there is a protocol which is coming, we subdivide the pool, and only this pool, if a protocol is going default, only the pool which has been impacted, on which the protocol has been borrowing, is impacted. So not everybody in the protocol. So at some point you could see and choose from which protocol you are okay to actually lend your assets or actually make access to your assets. And after that, it's just a matter of are you okay to take more risk depending on the credit score that we put on some other protocols.
Right. And what assets will you originally start off with where these whitelisted parties can borrow from? Like, what can they actually borrow?
Yeah. So this is a discussion that we had with a lot of on-chain actors. It's funny because it depends actually on the use cases that they are willing to do, and most of the time it's blue chip assets like Aave, Comp, Sushi, DYDX, stuff like this. Those are the assets that they are not. Most of the actors don't want to hold on the long term, and they are much more okay to keep your stable coins and borrow those assets first. If we are talking about market maker, for instance, they are much more keen on actually borrowing stable coins like USDC or USDT. So it really depends on who we will start building with. But as of today, I think we will much more. You will see Aave, Sushi, those tokens being borrowed first.
For sure, makes sense. Just want to welcome McFly, who just joined us. He was just on a previous meeting. It's good to have you with us, bud. We'll continue on here. Alex, I just have a question. Like, I'm wondering, do you think that anyone or someone as like a bad actor could ever try to influence a vote by simply going out and borrowing in an under collateralized fashion? Like, I'll just give you an example. I don't know. Like, let's just say there's a governance vote happening with sushi, and some big actor wants to really throw their weight around, and they go ahead and borrow. Have you guys thought about that at all? Obviously, I know it doesn't impact the protocol in any way, but I'm just curious if that's ever been brought up at all.
Yeah, that's a very good question because I've never been asked this question before, and that makes a lot of sense. So in a way we thought about that because one thing that we want to do is keep track of where the funds went and all, because I had discussion with people saying like, okay, can I just borrow from your protocol and I don't know, replenish my reserve? And I was like, whoa, what the hell? Like it's not even like I don't even want to consider that. It's very bad. And actually, that's what happened to one of our competitors, which one of their protocol, which they've been partnering with, got hacked, and they had like a multiple million debt, and they basically moved the debt from their protocol to the under collateralized protocol. So I definitely don't want that to happen. And so we want to find ways to keep track of how the funds are being used, and we want to do that as much as possible through smart contracts. And so we want to automate the use cases, because also one cool feature with that would be that protocols, as soon as they are whitelisting once, they can borrow whenever they want. And so they can integrate with our protocol and fetch liquidity depending on certain variables. So we could like have some threshold, obviously, in order to not make them do whatever they want with our liquidity. But it's, I think, a cool feature. So that makes us have to follow where the money is going. So if we see that, so if we lend some funds to like sushi tokens to a DEX, for instance, we will need to make sure that these funds are being used for the right purpose and not used for voting for a protocol improvement proposal.
Right. No, for sure. This is super, super interesting. I'm really enjoying this conversation. So I want to do something a little bit different than we usually do. I'm going to open it up to the audience. If at any point you have a question, please feel free to raise your hand. We'll bring you up on stage. We're going to continue with our usual segment. But if you did have a question, because this is sounding like some cutting edge technology that's about to come out, feel free to raise your hand so we can bring you up on stage. Back to you, Alex. So let's talk a little bit about maybe the advantages of lending on JellyFi versus, let's just say, what most DeFi users are used to or accustomed right now with the big protocols like Aave and Comp in an over collateralized lending protocol. What would you say is some of the bigger advantage? I mean, obviously, okay, I'm sure interest rates, but is there anything aside from that you can really point out?
I mean, different, like everything is about APY, right? When the people are lending, they first are looking as to what is the biggest APY, and so that's why you end up with protocols which are like saying, okay, yeah, there's 10,000 percent APY, 100%, 1,000%. We usually, when there is that much that big numbers, it's either because there is a Ponzi or LP rewards which are being included, then that inflates the numbers, but that doesn't reflect the health and the health of the protocol, and it's definitely not long term. We are trying to build something which is long term and which doesn't reinvent the wheel. So when I was saying that you could delegate your funds from Aave onto a protocol, that's one advantage, because you could be lending on Aave and you could use your funds lent on Aave, or either your A token or the credit delegation feature, to deposit those funds again on our protocol. So if you have collateral which is sitting on Aave, we will be giving you basically another APY on top of the one you are using on Aave. Plus, in the end, like DeFi is super risky, right? It's all about when you are trading, when you are lending, when you have an APY, you are taking a risk at the end of the day, because like when we earn money like this, there is always it's always function of the risk. We think that lending to corporates which are carefully chosen, on which we did some due diligence, which we assessed through credit scoring and so on, that we perform KYC at some points. We think it's less risky than buying, I don't know, a shit coin from the top 100 coin on CoinMarketCap, or the new asset from whatever protocol which is launching and which is hot, or which whatever NFT is being released. So it's, I think for the I think there is going to be much more corporates which will be lending onto a protocol that we think, because those protocols are looking onto to an alternative which is still have some good APYs, but which is less risky. So I think the best advantages that we have is that we have this middle ground in terms of a high risk, high reward situation.
Alex, earlier you mentioned that the protocol wants to get a sense as to where these funds are going and how they're being used. If a actor is not in line with how they say they're going to use their funds, would that affect their credit score, so to speak? I'm assuming once the funds are in their hands, there's nothing you can do. They can pretty much do whatever they please. But I'm assuming that going forward, that would sort of taint their relationship with you guys in the future?
Yeah, for sure. I mean, we can't let them do whatever they please. We need to make sure that there is a number of like watchdogs which are here in order to prevent them from doing anything, and that the whole purpose of the funds are being used in the right way. So we are also we took a look at OpenLaw, Kleros. So you could have like smart contracts. We have like a legal binding, and you could. I don't know if you know Kleros, but it's a decentralized jurisdiction court in which you can bring like when you have fights and stuff, you can settle them there in a decentralized way. I would rather don't want to end up doing this because it's a heavy process, and you never want to apply those solutions in the end. But we are thinking about ways to actually have some incentives for protocols to use their funds in the right way, and we think that if we can guide those funds through smart contracts first, we don't need those legally binding smart contracts. And if we can't do that for every purpose, every use cases, then we will need to find other ways. But just to let you know, like on the first use case that we are targeting, it's definitely feasible. So that's why I'm saying that we won't need OpenLaw in the beginning. But as soon as the use cases become more and more tricky, we might need to think about other ways.
For sure. And I want to go back. We talked about the default process. I'm wondering, would all lenders across the board be affected? Would a specific pool itself? Maybe you can talk about whether there's going to be a JellyFi token that sort of acts a little bit as like a buffer in terms of like worst case scenario. What happens in that process when there is a default?
Yeah. So Yeah, there will be a JellyFi token. It will be mainly used as a, like, I'm sure you know Aave, the Aave. So there's the Aave token, which is used as a governance token, and mainly it will be used in the same way. It will also be used in order to vote for which protocol to whitelist in JellyFi. And we are not planning on launching it yet because we want to find our product market fit first and launch the token later, to have the correct incentives and make sure that it's not, we don't want that to be just a token which is not being used for the right purposes. So we want to make sure that it's rightfully rightfully designed, the links are there, and are staking into the safety module. So if there is in case of default, you slash a part of the safety module, which is used in order to replenish and cover the losses of the people involved in the liquidity pool impacted. So obviously, on our hand, what we want to do is make sure that the liquidity pool impacted are as small as possible, and that we slash the safety module as little as possible as well. Like we want that to be used in last resort. We never want to consider that as just a treasury that we can just slash whenever we want. No, the idea is really for that to be to be last resort case, and we want to make sure that if there is something which like a default app happening, is that everything that we put in place before that is wrong, and so that we need to make sure that our market engine and the risk assessment framework which we are building is prevent that from happening ever again. And yeah, I mean, if this happens again, then we need to make changes which are much more fun.
So at 88 MPH, there's a strong focus on guaranteed interest rates over a specific duration of time. I wonder if the 88 MPH community would be open to like an integration with JellyFi where they're aware of a higher risk but a much higher term based on a specific duration of time. So like, for example, you have a whitelisted on-chain actor who wants to borrow funds for a year and they're KYC'd and blah, blah, blah. And, instead of the typical whatever interest rates available right now in any of the 88 MPH pools, they might be looking at, let's just say, a 15% to 20% APY. I'm curious if anyone on stage or in the audience wants to comment on that. I'd love to get your feedback.
I mean, I think it could be cool. We are also building a new solution which involved an order book of interest rates. So you could actually specify your own interest rates on which you will be willing to lend to certain protocols, and you would have, like, as soon as the protocol is borrowing from JellyFi, we will fill the borrowing pool with the better interest rates. And so I think I think that could be something which would be fun for the community to play with.
Yeah, I agree. McFly, any comments on that?
No, yeah, definitely agree with Alexi regarding that. There is a lot of different synergy, and we will always look for different stream of yield. So at least at first, making sure that we don't deal with any additional risk for sure. But I think, Alexi and his team have a solid project. So we'll see when they will be ready. We can definitely work together for sure.
Yeah, that's cool.
Exciting. So going back to our here. So How does JellyFi deal with the capital risks associated with the under collateralized loans, like specifically though? So we talked a little bit about KYC. We talked about on-chain actors. We talked a little bit about the token and the buffers. Was there anything else that you wanted to add to that sort of mitigates the under collateralized loan in general?
Yeah, sure. I mean, we have been building what we call we are building what we call a risk assessment framework, and this piece is like as big as the protocol, the infrastructure of the protocol in itself, which is basically assessing the risk and basically answering the question what happens in case of default. You we talked about the safety module. We talked about a number of other mechanisms, but at the end of the day, I think with reputation risk, in crypto, when you look at it, reputation is everything. Your community is very important. If you mess up with that, I think you will end up in a bad situation that you want to avoid at all costs. So basing yourself on reputation, basing yourself on diversification, which we are doing through the pool segregation, while testing every candidate through a big due diligence process, having the safety module that we talked about, and in the beginning dealing with limited maturity loans. I think you have a quite solid assessment in the big for the first version. I mean the first loans that we are thinking about doing, the maturity of the loan would be less than a day or a day. So you would be lending money to a protocol which is borrowing on a daily basis. So with that, with a limited maturity, it enables us to build credit history, which is also a good way in order to figure out this protocol is a good or bad actor. But also
Yeah, for sure.
so that's on the V1. But on the late stage, we are looking at on-chain insurance. So there is a number of actors which are building on-chain insurance. I'm sure you heard about. We also are thinking about building a credit default swap marketplace on which you could have institutional partner on the selling side. And like I said, a trustless way to track the funds, and also we could also it's a kind of happen. It's the same way it's happening in traditional finance. It's the way the future earnings are being seized in case of defaults. When a corporate is doing still have some stream of your revenue in the future, but is going to default. The revenue is first used to pay the people he needs to pay out the debt, and that would be also a way for us to mitigate the risk, like have a trustless way to lock future earnings in case of defaults.
Awesome. I love it. I love it. Before we get into the next segment, which we'll talk a little bit about news and updates, I'm curious what your take is. When do you think we'll see under collateralized loan solutions for individuals? So maybe people that are not KYC, or maybe non-large corporation or whatnot. Do you think it's possible? Are we near? Have you guys ever even thought of a solution for like individual retail use cases?
So yeah, actually, when we first worked on JellyFi, the idea was to do under and zero collateralized loans on the peer-to-peer level, but we quickly changed that to corporate because it was way too complicated and the risk was through the roof. was going through the roof. But since then there is a number of solutions that have been created, which are targeting the soul like the MetaMask basically, and trying to scan your MetaMask, see how you behave in DeFi, and basically give you a note, a score on whether you are a bad trader or a good trader, a bad actor or a good actor basically. And as of today, it's being used as if you are a good actor, you have a better APY and a smaller RPR. So you borrow with a smaller interest rate. And if you are a bad actor, you have a higher interest rate for borrowing, and a higher a smaller interest rate if you are lending. So it already exists. For me, it's still very proof of concept. So, and it's super risky. I would not want to lend to such a protocol as of today. But yeah, for sure, it's something that's going to come, and I think it's going to come sooner than we expect.
That's awesome. I can't wait for that. So for the next segment, I'm wondering if you could share with us what sort of major milestones has JellyFi surpassed that's sort of worthwhile mentioning right now, and maybe you can talk a little bit about what's upcoming on the roadmap. What would you like to share with our listeners today?
Yeah, so we released our alpha on testnet last month, a month and a half ago now. So that was a good milestone achieved. We are now working on the V1, which is going to be released later this year. I think first on testnet in a matter of months, 1 to 2 months, and on mainnet end of Q4 this year. And the biggest milestone that we achieved, which is not public yet, but is the success we successfully raised. So we closed our seed round and successfully secured 2 years of runway. So yeah, that's a big milestone in itself, because now we can hire and scale the team. So yeah, with that, we will make sure that the V1 is a super cool product, and that it launched with as few security breaches that we can find, and yeah, build the community, have an awesome product. That's about it.
That is absolutely amazing. I want to remind everyone in the audience that's listening with us today, please feel free. We are going to go into our Q&A section, but if there was something that you wanted to ask now, please feel free to go ahead and raise your hand. I want to pass it off to McFly. If you want to sort of brief us on any news or updates that you want to share with us today, that'd be amazing.
Yep, sure. Thanks, Weaver. I wanted to thank you, Alex, for coming here. Really cool to have you. Really looking forward regarding what you are building, and happy to invite you again in the community call when you have some news. So definitely reach out to us, and stay in touch with us in the following months. I know, like, the last time we spoke together, you told me you are targeting maybe early 2022, right, to launch something on mainnet?
Yeah, so thanks a lot for the kind words. And the main target that we have is indeed, so we booked a slot for from a big audit firm in January 2022. It's a pain in the ass because everything is booked until then. We don't want to scale the product and before it has been carefully reviewed by certified auditors. So the approach that we took is launch a way smaller version of the protocol by the end of the year, perform a bug bounty program, and then at the end of it, allow like certain people to participate into the protocol, knowing that they are taking a lot of risk, because it has not been it has been audited, but to a certain degree, not like fully, like not a certified firm that have been delivering a stamp of approval.
Yep. I feel you with that. I was just discussing today with one firm. They told me, yeah, it will be April 2022. So yeah, you need to be patient.
Yeah, too many protocols which are being launched today. So too many creation, too many ideas that needs to be built. And if you guys in the audience want to join the audit field, feel free to reach me.
Highly, it need a lot of new guys to help with that for sure. Cool. So yeah, thanks for your time, Alex.
It looks like we have someone on stage who wants to ask a question. Should we do the question first before the updates, or do you want to run through the updates first?
Sure. No, go ahead.
So, Muir, go ahead.
Great. Yeah, thanks for having me on. Thanks for coming here, Alex. And I was just curious if there would be any attempt by JellyFi to pursue defaulters through traditional legal channels, or if that would be completely avoided.
No, actually, that makes sense. We could do so. Like I said, I mentioned earlier OpenLaw, which is trying to do so, like trying to bind the blockchain world and the traditional world, having some legally binding aspects embedded into smart contracts. So that could be something we could have. And yeah, I'm not sure if we want to do that first, but I mean, at some point, I think it's something that we might do. Yeah.
Okay, cool. Thank you.
Thanks. Go ahead, McFly.
Okay, cool. Just before starting, Whipper, you will do the raffle at the end, right?
Yes. We will open it up once again for Q&A after you give the updates, just in case anyone has any questions. And then at the end of Q&A, we'll open up for the raffle. And then we'll touch base with Josh with regards to minting the PO app.
Cool. So thanks. Hi everyone. I suppose a lot of you spotted some activity recently on our GitHub, closing a lot of different branches regarding our last audit, deploying some stuff, a lot of different transactions. We spent a shit ton of ETH in the last 48 hours for pushing some transaction basically regarding 88 MPH v3. I was just in a meeting before this call with the firm, so we were discussing what we need to do in order to launch all of that publicly. So the good news is we are ready to launch everything publicly, but there is some small stuff we need to do first before being able to do that. So the things that we need to do is deploying the new asset pools. So we will support Aave, Compound, Harvest. We won't launch all the assets at once because we want to be sure, at least for the next 15 days, that nothing really horribly wrong happens. So we don't want to deal saving 20 different assets, 20 different pools if something wrong happens. So we want to really, maybe we will support 6 or 7 assets at launch. So free on Compound, free on Aave, and maybe 1 on Harvest. And after we'll scale all of that in the following weeks, maybe releasing everything at once. That's the strategy, at least regarding the assets. We need to do that, so it will take us some time to do that today. We will be able to start doing that at 4:30 p.m. PT today. So it's in a few hours. And so probably it will happen between today and tomorrow. So that's the first step. After that, there is another step regarding the rewards, the revenue for the MPH stakers. We need to redirect that to the new dumper contract on V3. The dumper contract is basically the contract that allow us to swap DAI, swap RAND BTC, swap whatever we are harvesting on the different protocol and the the paid out interest fee. So we will need to migrate that on the Damper v3. And I have my list of things. So for this reason, I'm struggling to list all of that. But the last big thing is also double checking everything is going well when we deploy the pools. So testing out this and fix other minor stuff. So we decided to release publicly everything on Tuesday, September 7 at 10 a.m. PT. So that's the big news. So all of that to say that, yeah, we need some time to release everything, to check everything yet, because we can't do all of that at once. And what will happen is we will start the MPH rewards on the V3 just Tuesday, September 7. So the V2 rewards will stop on Tuesday. Of course, the MPH vested will continue to be vested. The MPH rewards for the floating rate bonds will continue, of course, on V2. But any new deposit won't get any more the MPH rewards. So that's the update, guys. So I know that we were kind of saying, I was kind of saying that we could be ready by tomorrow. But yeah, after discussing more, we prefer to buy us sometimes just to don't rush anything, because it will be really a mistake to rush these kind of things. And we are super close to all of that. So we decided to do September next Tuesday, September 7th for all of that. So in 5 days, you will be able to play with all of that. We will deploy everything on Tuesday on the front end to don't just have anyone trying to do stuff that can be wrong or that, yeah, ending reckless. So the front end won't be updated until Tuesday. And yeah, the last news, we will resume also the rewards, the MPH rewards on SushiSwap because it ended a few days ago. Uniswap rewards, we won't do anything yet for Uniswap because we wanted to focus everything on SushiSwap. And regarding the zero coupon bonds, we won't have at launch the zero coupon bonds, just to simplify the launch and making sure everything is working as expected before releasing maybe 1 week or 2 weeks after the zero coupon bonds. With the liquidity pool for that, probably on SushiSwap. And after it will allow us to start thinking how we want to build the structured product. So yeah, that will be other project inside the project. But the focus after, and we announced that since a long time, it will be on scalability. So we will focus first on releasing everything on Polygon. After we make sure everything is all right on Ethereum mainnet. So yeah, that's the news, guys.
That's awesome. That's awesome. Thank you for sharing that, McFly. Opening it up to the audience. Do you guys have any questions? If so, now's your time. Please feel free to raise your hand so we can bring you up on stage. I'll pause here for a small moment, and if we don't have any questions, we'll continue to the next segment of our call.
Yep, and while everyone think about questions, the thing I will announce right after this call publicly all of that. I saw today that there was some guys tweeting about like, hey, there is some stuff moving at 88MPH. Maybe they are trying to scam everyone and doing a rug pull or stuff like that. So yeah, that was just basically V3 deployment happening right now. So yeah, I posted publicly comments there on Twitter and here on Discord. So yeah, just updating you guys. And I think it's good right now to announce publicly all of that. We didn't communicate much about the V3 deployment because we didn't want it to have too much attention at first before being sure that what we are doing is will end up correctly on mainnet and at the time we want. So right now we are sure that we can release all of that on next Tuesday. So we will announce publicly all of that. And the other reason was we didn't want to have anyone like a chiller on Twitter starting pump and dump stuff on us. But yeah, we can't really protect everyone from that.
Thanks for that, McFly. So it doesn't seem like anyone has any questions, so we're going to go on to the raffle portion of the call. I invite everyone to jump into the general channel of the 88MPH Discord server and to drop a number between 1 and 50. And the person who nails it or gets closest to will be... Oh, sorry, I'm getting a message from Steven that there was 2 questions coming through. Hang on. 1 second. My apologies, guys. Let me just go to the general.
Would you like me to read the question out?
Yeah, sure. Sorry, I was just jumping from different screens here. Go ahead, Josh.
Okay. So I think Stephen's question is for Alex, and it is it possible to back without decision of the borrower? For example, is it possible to create a smart contract where trading occurs on the borrowed funds, and if the loan is not paid back by a certain date, then those borrowed funds are in a sense taken back by the protocol or liquidated?
To my knowledge, I don't think so, but I mean, that might be the case actually. I don't think I can have like a real certain answer on this, but we have been thinking at some point on mechanisms that incentives borrowers to actually repay their loans before the end of their maturity, depending on certain variables. So if we could see that a protocol is we suspect something is moving on from protocol to a protocol, we could trigger some margin call to those protocols in order to repay part of the debt. And if they refuse to do so, then we consider they are going default, basically. So the previous mechanisms that I mentioned earlier will take place.
Thanks, Alex. I hope, Stephen, if you're in the audience, that helped helped you or helped answer your question. I can't see the other question more than it's just an extension of that question we just had. So I think if we want to go ahead and do the raffle, McFly, if you'd like to put a number in one of our private chats, and then we can.
Yeah, let's. Josh, do you think we should get everyone to enter their numbers in again, or those numbers are good?
I think these numbers are good. Last 5 seconds if you haven't done your number, and then we'll do it again if you have. We'll take your first number. Okay, perfect.
McFly, if you want to drop the number in our private chat, that'd be awesome.
Drop it.
Josh, if you could help me scan the numbers, that'd be great.
Okay. We have our winner. President of Smart Money, or El Presidente. Nice. You won that number.
All right.
15, so 16 was closest.
All right. Congratulations. Please send a DM to McFly or Josh, and they will get your raffle sorted out. Josh, with regards to minting the POAP today, how do you want to go about that?
So the POAP is minted, and everybody that's commented on this channel since 6:30 will be sent a POAP.
That's amazing. That is awesome. Okay, with that, everyone, I want to thank everyone for coming out today, showing your support for 88MPH. We want to thank Alex from JellyFi for coming out and explaining the protocol and project to us. It was super, super informative. I learned a lot. I can't wait for it to go live. Thanks for coming on. And we want to wish everyone an absolute wonderful day. And hopefully you guys will join us sometime next week, same time, here in the Convention Center.
Cheers, Papa. Cheers, Alex.
Have a good one. Bye, guys.